The next significant event happened in September of last year, where we had some bank failures, one in England and some other failures here in the United States. The third wave culminated with the Bear Stearns collapse in March of this year, and the fourth wave was September of 2008. And this is certainly the most severe of the four waves. You might liken it to living in Houston in storm season. We've had several big storms over the last 2 years, and now the big hurricanes finally come in and hit the economy, and the resultant destruction of value that goes along with a large storm hitting a community like that. And that's essentially what's happened to the global economy. There's been a large destruction of value. So I remember this morning that the decline in world stock markets over the past month is larger than the GDP of China. That's a big number. I forget how many trillion it was. It's a very big number. I thought for a minute, and this is especially where the personal opinion comes in, that I talk about the causes of this financial crisis. And it really gets back to the same old thing. History does repeat itself to some extent. We've had investment bubbles in the past in all kinds of asset classes, from tulip bulbs to gold to technology stocks. This time it was multiple asset classes. The most visible was the mortgage market, but there were other asset classes where there was actually a double in the price. This was reinforced by really a decade-long infusion of liquidity into the global financial markets. Not only the Federal Reserve in the United States, but banks around the world have been pumping massive amounts of short-term money into the market for a decade. This excess liquidity has caused, on a relative basis, low interest rates. These low interest rates, in turn, caused investors, portfolio managers, to try to increase their yield by the use of leverage. It's happened before, it will happen again, but maybe we'll be a little more cautious for at least the next decade or so. But if you look back in history, bubbles occur one size or another every 10 or 20 years. Certainly every generation there's some kind of an asset bubble that causes some problem and leads to, shall we say, multi-decade repercussions as we go forward. Like that and everything else. We can't forget the profit motive. That really was driven by the liquidity, by the low real return, low nominal returns that people were getting on investments, and the ever-present need to grow earnings. Always have a constant upward stream of earnings, cause people to lever their investments, whether these investments be plant equipment, commercial real estate, residential real estate. Individuals do the same thing, feeling rather comfortable with the increase in the price of their home, feeling that their balance sheet was improving as their home price was going up, feeling that they were able to take on more debt simply because they had the asset value. And at some point in time, both the lender and the borrower lost sight of the fact that you still need that income flow to pay the service on that debt. Corporations were guilty of the same thing. This particular cycle got maybe more carried away than many in the past because of some developments in the investment markets. First would be the securitization of assets. And this I could talk about for about a half an hour without any problem. But the real crux of the issue is this. The system for generating loans, and we'll use mortgage loans as a prime example, that's why I call subprime the poster book. The system generated profits for loan originators based on the amount of volume produced and their recurring fees for servicing these mortgages. Originators get paid a fee to collect the monthly payment and send it on, pay the taxes, do whatever. But the principle of the mortgage was packaged up into securities and sold to investors around the globe. The big problem with the German banks we have right now, and Germany really hasn't faced up with the crisis. They haven't come up with any particular solutions for their banks yet. The Germans were very big buyers of securitized U.S. subprime mortgages. The process of securitization causes a disconnect. We call it the agency problem. The originator of the loan has no real responsibility for the performance of the loan. His only motivation is to generate fees by writing the loan and by servicing the loan, and all of the risk is sold to the investor in the securitization market. So that the actual risk taker and the person that's underwriting the loan have totally separate incentives. That disconnect causes some real problems in terms of abuse in the mortgage market. To some extent, you could say the same thing with corporate debt. As collateralized debt obligations became, and that's just a packaging of corporate bonds, some high quality, some low quality, but packaging them up into these securitizations and selling off pieces of it to investors around the globe really continue that agency problem and have a disconnect between the investor and the asset and the person who was originating and underwriting the loan. And sometimes those underwriters had some economic incentive to bend the rules a little bit, to lend a little more, to assume that the house value was going up, so we won't worry about whether there's enough income to cover the mortgage payments. We'll assume that the borrower is going to have an increase in their income over the next several years, and they'll be able to afford it later. Why don't we just come up with maybe a mortgage that has a low payment at the start, and the payment increases over time as their income goes up? That was a good idea. That's called the adjustable rate mortgage, which they put a teaser rate on. You couldn't qualify for a mortgage at a 6% yield. You didn't make enough money. So let's make it a 4% yield for a couple of years. You can qualify for that, then in 2 or 3 years your income will go up and you can afford the payments at that point. The problem is, in many cases, in that interim period, the value of the real estate actually declined below the amount of the mortgage. The mortgage holder goes upside down, the payment is going up. He has to decide, do I want to try and make this payment for a loan that's bigger than the value of the property, or should I just give it back to him? And that's what's happening in a lot of places around the United States and even in other parts of the world. And the final excess that occurred in this cycle was the use of derivatives. Derivatives are, theoretically, at least a very good thing. They allow people to hedge risks of all different kinds. But the other side of a hedger is a speculator. And taking some of these risks, some of these macroeconomic systemic risks, and putting them into derivative form allows investors to lever their bet on what they think is going to happen. And they lever it very, very strongly. And a lot of these levered bets were being made by financial institutions. Witness the large broker-dealers of the United States and some of the large banks. And we'll back off of the banks. The large broker-dealers, which are pretty much non-existent now. The last two, Morgan Stanley and Salomon Brothers, or Morgan Stanley and Goldman, that's it. Morgan Stanley and Goldman have become bank holding companies. While they were broker-dealers, they levered their balance sheet on average 25 to 30 times. Lehman Brothers was trying desperately to go from 30 down to 25 when they just ran out of time and had to file for bankruptcy. They would take this levered money that they had and invest that money in some of these derivative instruments and some of these securitizations that were, in a sense, leveraged bets on a particular outcome in the economy. That results in huge leverage that if you're wrong, or if you have to all of a sudden if you're wrong in terms of timing, but you're right in the actual bet that you're making, you can still run out of time when you have something similar to a margin call, and that's what happened with the FASB pronouncements. They had to mark their assets down, and they tried to make the case that that's okay, we can wait it out, we have enough capital. But with a change in accounting standards, they weren't able to hold the market price, and the capital started to erode. So what we have is a global system, a global financial system, that essentially is undercapitalized. It's led to the failure of Fannie Mae and Freddie Mac. It's led to Bear Stearns and Lehman Brothers going away. All of the banks in Iceland now have been nationalized. 4 banks in England have been taken over by the government. 1 in Holland, actually 2 in Holland. Germany hasn't faced the music yet. We've had Merrill Lynch being sold. It's truly a global financial crisis that's probably reached its peak in terms of panic at this point in time. But nonetheless, in the month of September, late September, about the 17th, the world financial system was close to total failure. There was basically no credit available for financial institutions anywhere in the world. It truly was a crisis of massive proportions, one we've really never seen before. And there are going to be a lot of consequences